The risk reversal strategy requires you to make a call and a put trade simultaneously on the same asset. Normally, this strategy is deployed when the market is extremely volatile, leaving you unsure as to which way the market will go. Let's say an asset that you're interested in trading seems to be on the rise, but you get conflicting signals which indicate that it may also go the other way at any time soon. Normally, you will be advised to avoid making a trade in such a scenario. But with the risk reversal strategy, you can still place a trade and with minimum trading risk, since you're taking up two positions. In this video, we're going to show you how to use the risk reversal strategy in 3 simple steps. Step 1. Pick out the asset that you're going to trade in. In our example, we will use Twitter as our selected asset. Decide which direction you think the price will go as the primary direction. If you think the price is going to end up higher, then the call market position will be the primary transaction. If you think otherwise, then the put position is going to be the primary trade. The reason why we need to differentiate between the primary and secondary trades is because of the payout ratio. Step 2. When executing the risk reversal strategy, always make sure that the payout for the primary trade is higher than the secondary trade. The payouts cannot be equal as well, as this will result in you incurring a loss whichever way the price moves. Remember, the objective of this strategy is to minimize your potential loss if the trade does not move the way you predicted. In our example here, we set the payout for the primary trade at a maximum payout at 75%. This means for every 100 euros we invest, we will receive a 75% return on our investment if our trade closes in the money. And if our primary trade closes out of the money, we will still receive a small rebate of 5%. For our secondary trade, select the minimum payout of 55% with the highest rebate at 25% from the drop-down menu. By doing so, even if our secondary trade closed out of the money, we will still get a rebate of 25% back. With these payout ratios selected, invest 150 euros for the primary trade and 100 euros for the secondary trade. Step 3. Once we have decided on the payout ratio for both the primary and secondary trades, simply execute the trade and wait for the trades to expire. Upon expiry, you will have 2 possible outcomes. If the primary trade closed in the money, then you will receive a total of 262.50 euros from the primary trade and 25 euros rebate from your secondary trade, making it a total of 287.50 euros and hence earning you a net profit of 37.50 euros. If the primary trade closed out of the money, then you will only receive a total sum of 155 euros from your secondary trade plus 7.50 euros rebate from your primary trade. This means you would have made a net loss of only 87.50 euros from a total investment of 250 euros. In other words, you have managed to reduce your potential loss by a considerable amount, while managing to cover both sides of the trade.